Imagine, for just a second, that you're building this massive global consumer electronics empire.
Right.
Like you are the absolute architect behind the ancestral company that eventually spawned, these giant global smartphone brands like OPPO and Vivo.
Oh, yeah, massive brands.
Right. And you've totally conquered the hardware supply chain. You've reached the absolute pinnacle of industrial success. And then,
You just walk away.
exactly, you just step away, you quietly relocate to Palo Alto, California, and you just start managing a $20 billion public equity portfolio from your office.
I mean, it really is the ultimate second act,
Hmm. Yeah.
because you're going from this relentless, just daily grind of global manufacturing logistics where you were literally fighting over fractions of a cent on components.
Oh, I can't even imagine the stress.
It's brutal, but you go from that to the pure, unadulterated capital allocation game.
Right.
You are no longer building the machines.
Right.
You are directing the flow of the financial energy that actually powers them.
Wow. Yeah. Well, welcome to today's deep dive, everyone. Today we are looking at the Q1 2026 13F filing of H&H International Investment.
Which is always a fascinating read.
Oh, absolutely. And for anyone listening who doesn't, live and breathe SEC regulatory documents, a 13F is basically a mandatory quarterly report card.
Right.
Any fund managing over $100 million has to show the public exactly what U.S. stocks they bought and sold. So today, we are looking at the report card for the fund managed by Duan Yongping.
Yeah, and he's frequently referred to in the financial media as, China's Warren Buffett.
Which is quite the title.
It is, but as we'll see today, that title might actually undersell how radically unique his approach really is.
Totally. So our mission today is to decode this highly concentrated portfolio. We really want to understand how he blends this ruthless operational business intuition with classic old-school value investing, and then tops it off with a remarkably sophisticated options trading overlay.
Yeah, because understanding Duan isn't just about copying his stock picks.
No, definitely not.
I mean, by the time this 13F comes out, the trades are already months old anyway. What we are really after today is his mental framework.
Yes.
We are trying to reverse engineer how someone makes highly rational, completely unemotional decisions in an incredibly chaotic market.
Exactly. Now, before we unpack the portfolio, a quick note. To access more advanced researches, follow Guru's latest movement, and leverage our latest Deep Values agents, welcome to download Deep Values app from App Store.
Right.
And to track stock market temperature, welcome to download iOS app Buffett Indicator from Apple App Store or Bubble Watch from Google Play.
Awesome.
All right, let's just get right into it, because if we are going to understand where this $20 billion actually goes, we kind of have to understand the psychology governing that money first.
Absolutely. You can't separate the two.
Right. And with Duan, everything basically traces back to a core philosophical concept called benfin.
Yeah, benfin. It's such a fascinating cultural and business
And
doctrine.
how would you translate it, roughly?
Well, at its core, it translates roughly to duty or intellectual honesty and a really strict adherence to one's own circle of competence.
Okay, circle of competence.
Yeah. So in the context of running a $20 billion portfolio, benfin demands this absolute, uncompromising discipline regarding what you do not know.
Right.
It is the active practice of admitting ignorance.
Which, I mean, let's be real, is incredibly hard for very smart, very rich people to do.
Oh, it's the hardest thing in investing, bar none. But Duan asserts that truly understanding a business model is exceptionally difficult.
How difficult.
Well, he often tells people that developing a genuine comprehension of an enterprise takes an amount of effort comparable to like earning a 4-year undergraduate degree in that specific company.
A whole undergraduate degree just to understand one stock.
Exactly. And after decades of investing and, building global mega brands himself, he claims he has only attained that level of comprehensive insight into a very small number of companies.
Really? Like how many?
He usually points to Apple and the Chinese liquor giant Kuaichao Mutai as like the only two he truly understands at that level.
Just two. I love that standard so much. The undergraduate degree test. It completely forces you to strip away your ego.
It really does.
Because, you might read an article about artificial intelligence and think, oh yeah, I understand it. But would you pass a 4-year degree on the economics of semiconductor supply chains?
Definitely not.
Probably not. And that intellectual honesty leads directly to his next big operational concept, which is the stop doing list.
Yeah, the stop doing list is essentially the enforcement mechanism for benfin.
How does that work in practice?
Basically, when the underlying thesis of an investment is compromised, Duan's rules dictate immediate liquidation.
No hesitation.
None. If the business economics fundamentally deteriorate or, say, management starts acting contrary to shareholders' interests, or he simply realizes he misjudged the competitive moat.
He just sells.
He sells. Full stop.
You know, the way I picture this is like, it's like finally confronting the sunk cost fallacy in your own closet.
Well, that's a good way to look at it.
Right. Like we all have that one shirt or jacket we bought, and it was super expensive. It looked great in the store, but every time you put it on, it's just incredibly uncomfortable.
Oh, yeah, the sleeves are too tight or whatever.
Exactly. You don't
Hmm.
wear it, but you keep it hanging there for years, taking up space, simply because you paid a lot of money for it.
Yeah.
And that's exactly what most of us do with bad stocks. We hold on, just hoping they bounce back to what we paid so we don't have to admit we made a mistake.
And that psychological trap destroys portfolios every single day.
Yeah.
But Duan's system overrides that entirely. To him, the original purchase price is completely irrelevant.
Wow.
The holding duration doesn't matter. Even the tax implications of selling are secondary. If the thesis is broken, the capital is pulled immediately.
That is so disciplined. And that sets up the next principle perfectly, I think. And this one actually made me stop and rethink how I look at my own bank account. He operates on this axiom, holding equals buying.
Yeah, holding equals buying. It is a profoundly rational, almost robotic way to view an asset.
So how does he apply that?
He evaluates his portfolio every day by telling himself that holding an equity position today is economically identical to going out into the open market and buying that exact same position at today's prices.
Okay, so if I'm holding a stock at, say, $100, and I have cash sitting there, and I wouldn't go out and buy more of that stock at $100 today,
Right.
then why am I still holding it?
Exactly. You shouldn't be, because every single day choosing to hold a stock instead of holding cash is an active allocation decision.
It's a choice you're making every day.
Yes. So he benchmarks every single holding against the opportunity cost of his capital.
And how does he define that cost?
He defines it by looking at the prospective 10-year cash flow yields of his absolute highest conviction ideas. If a holding can't beat his best idea, it is liquidated and rolled into the better idea.
That makes total sense.
And he completely rejects reported accounting metrics like book value. Instead, he focuses purely on what he calls effective net assets,
Wait, let's translate that for a second. Effective net assets meaning what exactly?
meaning an asset is only productive if it generates durable, recurring cash flow that actually ends up in the owner's pocket.
Okay.
So if a company has this massive, expensive factory, but it doesn't produce cash returns that exceed the cost of running it, that factory isn't an asset to him.
What is it then?
It's a liability in disguise. It's an economic encumbrance.
Man, that is ruthless.
It really is.
It leaves absolutely zero room for sentimentality. And frankly, it explains why his portfolio looks the way it does.
Right.
Because applying that level of filtering leaves you with very few survivors.
Hmm.
I mean, we are looking at a $20 billion fund here, where the top 5 positions make up a staggering 87.13% of the total assets.
It's incredible. That is the definition of high conviction.
Truly. So let's look at those bedrock anchors. Apple and Berkshire Hathaway. Together, these two make up nearly 58% of his entire fund.
Yeah.
Apple alone is a $7.35 billion position.
Yeah. And applying Duan's framework to Apple reveals exactly why it survives that undergraduate degree test.
Right.
Because he doesn't view Apple as a hardware manufacturer.
He doesn't.
No. If they were just making phones, they'd be subject to the usual electronics obsolescence cycle, right?
Yeah.
Where competitors are just constantly undercutting you on price.
Yeah, which he knows all about from the smartphone business.
Exactly. He evaluates Apple as an inescapable consumer ecosystem.
Which, I mean, anyone who has ever tried to switch their family from iMessage to Android totally understands that ecosystem.
Oh, it's impossible.
The switching costs aren't just financial, they are social and logistical. It's an absolute nightmare to leave.
And that friction creates unmatched brand loyalty. And more importantly, highly predictable recurring cash flow, particularly through their services segment, the App Store, iCloud, Apple Music.
Right.
So you pair that high-growth ecosystem with his second largest position, which is Berkshire Hathaway, sitting at $4.38 billion. And he actually expanded his Berkshire holdings by 27.5% this quarter.
Okay, so if Apple is the growth engine, Berkshire is sort of the fortress.
That's a great way to frame it, because in Duan's view, Berkshire basically functions as an interest-bearing cash alternative.
Interesting.
Yeah, it has this massive cost-free insurance float and all these diversified non-cyclical cash flows from, railroads, energy, utilities.
So it's safe.
Very safe. It is the ultimate volatility buffer for the rest of his tech-heavy portfolio.
Okay, let me pause you right here, though, because as I was looking through the 13F data, A giant contradiction just jumped out at me.
Ooh.
What's that?
Well, we just established that Apple is his absolute highest conviction bedrock, right? It's the one business he understands better than almost anything else.
Right.
So why did he reduce his Apple shares by 10.55% this quarter?
Ah,
I
yes.
mean, that's an $854 million reduction.
Yeah.
If holding equals buying, did the Apple thesis break? Like, did he fail his own test here?
It definitely looks like a contradiction until you actually look under the hood. The thesis didn't break at all.
Okay, so what happened?
This is where Duan diverges from traditional long-only value investors who just buy a stock and, sit on their hands for 10 years.
Right.
He uses a highly systematic institutional options strategy. Specifically, he writes covered call options.
Okay, I'm going to need you to slow down and translate that for me.
Yeah.
Because rights covered call options just sounds like Wall Street jargon specifically designed to confuse people.
Fair enough.
Explain the mechanism to me like I'm 5.
Okay, let's use a real estate
Yeah,
analogy.
perfect. Imagine you own a beautiful house in a neighborhood where prices are suddenly just spiking.
Okay.
You love the house, but you think the market is getting a bit overheated. Then you find a buyer who is absolutely desperate.
All right, I'm tracking.
You tell them, look, I will let you buy my house next month for $1 million, no matter what happens to the market. But to lock in that guarantee, you have to pay me $50,000 in cash today.
Okay, so I get $50K in my pocket immediately.
Right now.
Nice. But what happens next month?
Well, 2 things can happen. Scenario 1, the neighborhood cools off and the house stays at its current value of, let's say, $800,000.
Okay.
The buyer obviously isn't going to pay you $1 million for an $800,000 house. So the contract simply expires, you keep your house, and you keep their $50,000.
That sounds like a great deal for me.
It is. Now, scenario 2, the market goes completely insane and the house jumps to $1.2 million. Right. The buyer exercises the contract, buys it from you for the agreed upon $1 million, and you miss out on that extra $200K in upside.
Yeah, but I still sold my house for $1 million, which I was happy with to begin with. Plus, I have the $50K premium I collected up front.
Precisely. That is the covered call.
Oh, wow.
And Duan does this systematically with his core positions like Apple.
So when the price goes up.
Exactly. When the market valuation outpaces what he believes is the near-term earnings power of the company, he sells other investors the right to buy his shares at a higher price.
And he just collects that premium.
He captures massive cash premiums. But if the stock price surges past his strike price, those shares are naturally called away. Like he is forced to sell them.
So that 10.55% reduction in Apple we saw?
It isn't a loss of faith at all. It's just a systematic harvesting of premium. His shares were simply called away in a rising market.
Okay, that makes total sense now. He's basically managing his concentration risk while getting paid cash to do it. But wait, does he run this engine in reverse? Like, can you use options to buy stocks too?
Oh, absolutely. He does that through something called cash-secured puts.
Okay, another term.
It's just the inverse of our house analogy. Duan determines a conservative worst-case scenario valuation for a target company over, say, a 10-year horizon.
So a price he'd be thrilled to buy it at.
Exactly. He sets a hard price floor. Then he sells put options, which basically means he is selling insurance to the market, promising to buy the stock if it crashes down to his floor price.
So he's essentially saying out loud to the market, I'll happily buy Apple at, say, $120 a share, and you pay me a premium today just for my promise to do that.
You nailed it.
And if the stock never drops, he just keeps the premium.
Yep.
But if the market panics and it drops to 110, he gets assigned the shares at his agreed 120, which he wanted to buy anyway.
Exactly. He is literally getting paid to be patient.
That is wild. It's a brilliant yield engine running seamlessly on top of a classic value foundation.
It really is an elegant system.
Now, we've seen the bedrock anchors, but Duan is clearly not just a passive collector of premium, because when the facts change, that stop doing list is activated with zero hesitation.
Oh, none.
And we saw a massive, ruthless pivot in this latest Q1 filing because he completely liquidated his entire position in Alibaba.
Yeah, this is a perfect illustration of Benfin in action.
Tell me about it.
Because historically, Duan has expressed immense admiration for Alibaba's founder, Jack Ma, and his whole early vision for Chinese e-commerce.
Right.
He even sold those put options we just talked about on Alibaba during previous market drawdowns just to acquire shares cheaply. But the competitive dynamics on the ground shifted fundamentally.
So what exactly changed the equation for him?
Well, Alibaba started facing persistent market share pressure from new entrants, But more importantly, the merchant dynamic shifted.
The merchants were leaving.
Yeah, sellers were finding better returns on their ad spend on rival platforms. The core economic engine of the business was losing efficiency.
Ah, so the facts changed, the thesis broke, so the capital just gets pulled.
Without a second thought. Following his strict discipline, he liquidated the entire 2.56 million share position, which was worth roughly $375 million.
And he didn't just sit on that cash either. He aggressively reallocated it to a direct competitor, right?
PDD Holdings, the parent company behind Pinduoduo and that global app, Temu.
Yeah, Temu is everywhere now.
It really is. And he increased his stake in PDD by 71.18%. It is now a $2.02 billion position.
Over 10% of his entire portfolio.
Right. Why drop Alibaba and make such a massive bet on PDD?
Well, this is where Duan's operational background as a consumer electronics industrialist really gives him a massive edge.
How so?
He actually served as a mentor and an early angel investor to PDD's founder, Colin Huang.
Oh, wow. I didn't know that.
Yeah. So he deeply understands the corporate culture there, which, by the way, is intentionally built on that exact same principle of Benfin. Okay, so it's not just a spreadsheet calculation for him. He actually knows the DNA of the executives running the company.
Yeah, exactly.
But what about the business model itself? Does that hold up?
Operationally, PDD runs what is called a consumer-to-manufacturer, or C2M model.
Break that down for us.
Sure, let's look at why that matters.
Yeah.
In traditional retail, a factory makes a product, sells it to a distributor, who then sells it to a wholesaler, who sells it to a retailer, who finally sells it to you.
Right, and every step adds a markup and more overhead.
It's incredibly inefficient.
Super inefficient.
But PDD software basically aggregates consumer demand and routes it directly to the upstream manufacturing clusters in China.
Oh, so it just completely cuts out the middleman.
It completely eliminates the traditional distribution middlemen.
Mm.
Because of this, the business is incredibly asset light. Historically, actual physical fixed assets make up less than 1% of PDD's balance sheet.
Right, less than 1%.
Less than 1%. They don't own the factories, they just own the network connecting the factory to the consumer. And this generates massive, just unencumbered free cash flow.
That's amazing. And I noticed in the notes something about an X-cash earnings multiple. Can you explain what that is for the audience?
Yeah, sure. So when Duan looks at the price of PDD stock, he subtracts the giant mountain of pure cash sitting on their balance sheet to see what the actual operating business is trading for.
Right, because the cash is just sitting there.
Exactly. And while the broader market was panicking about regulatory scrutiny and geopolitical tensions, Duan looked at PDD's net cash fortress balance sheet, saw that the underlying business was trading at a dirt-cheap X-cash multiple, and just doubled down.
Man, that's smart. So selling Alibaba shows his ironclad discipline.
Yeah.
But his newest, most surprising addition to the portfolio actually shows his willingness to completely shatter his old worldviews based on new data.
Yes.
Which brings us to the ultimate empirical update here, the Tesla shocker.
Yeah. This is arguably the most fascinating revelation in the entire 13F filing.
I couldn't believe it. He initiated a brand new $1.27 billion direct common stock position in Tesla.
Incredible.
It instantly became 6.34% of his portfolio. But hold on, the contradiction here is glaring.
Very glaring.
Because didn't Duan explicitly state in the past that he absolutely disliked the capital-intensive auto industry?
He did.
And I even read in the background sources that he voiced heavy skepticism about Elon Musk's character, famously saying he didn't want to be friends with him, even for money.
Yeah, that quote definitely made the rounds.
So how do we go from, I don't want to be friends, even for money, to writing a $1.2 billion check?
Well, it raises an important question about how master investors adapt, right?
Yeah.
Duan is a classic value investor, but his discipline allows for rapid empirical updates when verifiable operational facts present themselves.
Okay, so what were the facts?
The catalyst here wasn't a spreadsheet. It was personal and hands-on. He extensively tested Tesla's full self-driving, or FSD software himself.
Oh, really?
Yeah, he adopted a Model Y as his daily driver in California.
Okay, so he drove the car, experienced the tech firsthand, and it just completely changed his mind.
It did. He realized that Tesla is not a traditional automotive manufacturer, which means it is not a standard Graham-Dodd value play.
Okay, let's clarify Graham-Dodd for the audience real quick.
Yeah.
That refers to Benjamin Graham and David Dodd, the fathers of old-school value investing, right?
Exactly.
Basically hunting for cheap, beat-up companies trading below the value of their physical assets.
Right. And if you look at Tesla through a Graham-Dodd lens, it looks absurdly expensive.
Totally.
But from an engineering perspective, Duan recognized the first principles physics that Musk is actually applying to manufacturing.
Things like what?
Things like large-scale gigacasting.
And gigacasting is wild.
It really is.
For those who don't know, instead of taking hundreds of small pieces of metal and having robots weld them together to make the frame of a car, they basically have a giant press that stamps out massive sections of the car's body as a single solid piece of metal.
Yes.
It strips out immense amounts of time, factory space, and cost.
It's a total manufacturing revolution.
Yeah.
Traditional legacy automakers simply cannot retool their legacy factories fast enough to match those efficiencies.
No way.
But beyond the physical hardware, Duan recognized the AI moat.
Ah, the software side.
Right. Tesla's growing global fleet of millions of cars isn't just a transportation network. It is an unmatched, distributed data collection engine.
So every time someone drives,
Every single day, those cars are gathering billions of miles of real-world video data to train neural networks for autonomous transport.
so he realized he wasn't buying a car company at all.
No,
He was making a venture-scale investment in a robotics and AI data platform.
exactly.
And he just put his personal feelings about the CEO aside and followed the physics and the data.
Which is peak benefit.
That is peak Benfin. And Tesla isn't even his only AI play. He is heavily backing the picks and shovels of the AI revolution, too.
Yes, he is.
Let's talk about his massive position in NVIDIA.
NVIDIA is now his third largest holding at $2.41 billion after a staggering 91.29% increase this quarter.
Almost doubled it.
Yeah. And again, he doesn't look at them the way traditional value investors do.
Because historically, value investors avoid semiconductors.
Yeah, because they're highly cyclical. Demand booms, factories overbuild, then demand busts, and the stock crashes.
Right. But NVIDIA is different in his eyes. Why is that?
Because Duan views NVIDIA through the lens of architectural standards. NVIDIA isn't just selling fast chips. They have a structural software moat called CUDA.
Okay, but how does a software moat lock people into buying physical chips?
Think of it like a language barrier.
Yeah.
Imagine trying to translate a massive, complex encyclopedia from French to English, but your entire team of thousands of translators only speaks a highly specific, proprietary dialect of French that NVIDIA invented.
Huh. Okay, I follow.
For 2 decades, millions of AI researchers and engineers have built their workflows native to NVIDIA's CUDA architecture.
So they only speak that language.
Exactly. So to switch to a competitor's chip, even if that competitor's chip is slightly faster or cheaper, you wouldn't just be buying new hardware.
Right.
You would have to spend years and billions of dollars teaching your entire staff and rewriting all your code into a new language.
That is an incredible visual. The switching costs are basically insurmountable.
They really are.
It's platform lock-in on a global scale.
And when you combine that software lock-in with their system-level hardware integration, NVIDIA ultimately delivers the lowest total cost of ownership for these massive data centers.
Wow.
Duan looked at Jensen Huang's execution, noted that Wang articulated this exact accelerated computing trajectory over a decade ago, and systematically executed the capital allocation to make it reality.
It's just amazing to see a traditional value investor find such massive, durable moats in cutting-edge tech.
It really is.
Now, he does have a few classic opportunistic tracking plays in the portfolio too, right?
Yeah. With you.
Like buying United Health during the recent panic over rising medical costs, or scooping up Alphabet when the market thought AI chatbots were going to instantly kill Google search.
Yeah, those are textbook contrarian plays.
He essentially steps in when the market overreacts to short-term news.
Exactly. He identifies an enduring monopolistic franchise that is facing, temporary operational headwinds or sentiment dislocation, and he buys the normalized future cash flows at a steep discount.
Smart. But honestly, my absolute favorite detail in this entire $20 billion 13F filing is his position in Occidental Petroleum.
Oh, that's a funny one.
It's a $667 million stake. And it is incredibly refreshing to hear a billionaire basically admit, look, I don't really know the oil and gas industry. I just bought a fraction of this company for fun, specifically to track what Warren Buffett is doing.
It really is true, though.
Is it?
Yeah, he openly acknowledges that energy exploration is completely outside his core circle of competence.
So why hold it?
Well, holding that fractional position, which he actually trimmed a bit this quarter to fund his higher conviction tech assets, is simply an empirical vehicle for him.
An empirical vehicle?
Yeah, he bought it just so he has skin in the game to actively observe Berkshire Hathaway's capital allocation strategies in real time.
Like, I've got an extra $500 million lying around. Let's just throw it at oil to see what Warren is up to.
basically.
I love it. Well, okay, let's bring all of these threads together for you listening, because what we've seen today completely shatters the stereotype that classic value investing is restricted to, slow growth, asset heavy industrial stocks.
It proves that value investing is framework dependent,
Right.
not sector dependent.
Exactly.
Duan Yongping demonstrates that if you focus on durable economic moats, predictable cash flow generation, and unwavering intellectual honesty, that principle of Benfin,
Right.
you can build a massive compounded fortune right in the middle of the most dynamic technology sectors in the world.
So, how can you apply this masterclass to your own life and investments? I keep coming back to that ruthless rule: holding equals buying.
It's powerful.
It really is. Look at your own portfolio or even your own projects, habits, or relationships. If you wouldn't buy a particular asset today at its current price, or commit to a project today knowing what you know now, why are you still holding it?
Yeah, are you keeping that uncomfortable shirt in the closet just because you paid for it?
Exactly. It's a powerful filter for cutting through our own irrationality.
Yeah, absolutely.
Now, before we wrap up, I have to read this mandatory disclaimer verbatim for the audience. Disclaimer: all analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for research and entertainment purposes only and does not constitute any investment or financial advice or service. Conduct your own due diligence before making investment financial decisions.
Good to get that in.
All right, to leave you with a final thought to chew on today, we talked about Duan's ultimate requirement for true understanding, the undergraduate degree test.
Right.
If a master investor with a $20 billion portfolio, someone who literally built global empires with his own hands, believes he only truly understands 2 or 3 businesses well enough to pass that test, how much of your own portfolio, or even just the endless stream of news and information you consume daily, is just an economic encumbrance, masking a lack of true understanding?
That's a deep question.
Next time you look at a complex market trend, a stock chart, or a new piece of technology, ask yourself, could you pass a 4-year degree on how this actually works? Or are you just wading through muddy waters pretending you can see the bottom?
A fantastic question to leave on.
Thanks for joining us on this deep dive. We'll catch you next time.